but a lot of good information, a lot of good education. And I think tonight's subject on multifamily syndication, I think everybody wants to understand syndication, or a lot of people think they think they're experts in syndication. Well, we brought a syndication attorney, we brought two commercial real estate brokers, and we brought a specialist in self-directed IRAs, and I'm also a lender in the multifamily space, whether it's debt or equity, and recognize multifamily syndications in my lending matrices and opportunities for investors. So what we'll do is, let's get some introductions first on our panel. Then Anand will give a brief overview of syndicated real estate deals, and then I'll pose some questions to the panel itself, and then we'll open it up to some questions. Is that good? Okay. So why don't we start off with Glenn, and we'll give an introduction of who you are, what you do, and...
Yep. Glenn Gaines, I work with KW Commercial. I'm on a team. Antonio is my partner. We have a team of, how many now? We just grew. We got Jared over here, Nate, two others. We got our admin and Danielle. So we're a team of 5. We focus on mixed-use multifamily investments mainly, but we do get into multifamily development. And I'm taking your stuff. But so my background is I actually was in general contracting for many years, and I got into real estate about 6 years, and haven't looked back.
Antonio. DiCianni. Perfect. Is that pronunciated?
Perfect. I'm Antonio DiCianni. Like Glenn said, most of our background, our current positions are similar. Commercial broker, advisor, consultant, we run a team. My background is private equity real estate, where I spent the bulk of my career, about 10 years or so, working in that space, primarily around multifamily transactions in the middle market, call it $10 to $30 million world, structuring debt and equity, working on acquisitions and dispositions. We currently run a brokerage platform, but we do a little bit more than that, consulting, advisory. We also play a principal role in a number of transactions. We've done a number of syndications ourselves, so anytime we can be a resource to anybody, whether it's just bouncing questions or help navigate the process, opinions of value on a purchase or a sale, that's what we're here to do. So looking forward to hopefully meeting everybody.
Excellent. Ryan.
Ryan Fisher from CAMA Plan. I've been doing this for quite a long time in alternative investments. I'm familiar with, we do it all 50 states. We work with a lot of people locally. Our office is locally located in Hamlet, Pennsylvania. My father and his sister started the company almost 20 years ago. So we have a lot of relationships with people here, and we specifically just deal in alternative investments such as syndications, but we do a lot of real estate as well. So we enable you to take your retirement accounts such as IRAs, 401ks, 403b, whatever, and you can move that over into an account that you can, instead of buying a stock, for example, you can now buy 123 Ocean Ave, or an apartment building, or we're talking about syndications here tonight. I know you're going to go into that. We work with a lot of people that have PPM. PPMs are private placement memorandums / syndications. And people will raise money. A lot of that money will come from people using their self-directed IRAs to invest into these projects. R. Fisher at CAMA Plan, at Fisher's with a C, RFISCHER at CAMAPlan.com. My card's out there. If there's anything I can do to help you, please let me know.
And he's on Clubhouse now, so he's really taking it to the next step in social media strides. So now Rashawn and MW Law want to give a little overview, and then we can open up the questions for our panel, and we can go from there.
Yeah, well, thanks, Joe, for having me here, and to all of you guys on the panel. It's excited to be back here. My name is Adnan Merchant. I'm a partner at MW Law. Our law firm focuses pretty much exclusively in real estate investment transactions. Myself in particular, I focus exclusively on syndications and private equity funds. And so we represent syndicated deals, general partners, private equity funds that are investing into real estate and raising capital for all of that, right? So that's who I am, that's what I do. And so I'm going to give you guys a pretty brief overview of what syndications are, what some of the common terms are, and I think it's just going to be a pretty nice Q&A. You guys are really experienced people on the panel here, so it's going to be pretty nice. So with that, I'm just going to kind of jump into it. Can everybody see the screen, first of all? I'm going to stand like back here so that you guys can see it. And can Can anyone hear me? 'Cause I'm gonna try not to use this if that's okay. Everyone can hear me okay? I get really weird around mics, so. Okay, first things first, I know there's another attorney in the room. So disclaimer, nothing here is going to be actual legal advice. This is all educational purposes. Please consult a lawyer before you do any of these things, because I promise you, if you do some of these things wrong, the SEC will find you, and you do not want to be subject to the SEC. So that's the disclaimer here. I already talked about who I am. Really what we're going to talk about today are sort of like three things, and very broadly. The first thing is just, like what a typical syndication deal point is and what a syndication is. Then we're going to talk about some of the legal structuring behind the syndication. What does that look like legally as a structure? And the third, if we have some time to it, I'm going to get to the Securities Compliance. So before I jump into it, that third piece is probably the most important thing for people to take away in this room. If you're doing a syndication or raising any kind of private equity or private investment dollars for people, you are subject to Securities Compliance from the SEC. Please, please, please don't mess that up. Anyway, more on that later. So the first thing in syndication is really what it comes down to is economics versus control, right? That's what we're talking about here. You're going to take some of your investment dollars, you're going to invest it into a deal that's investing in real estate, that's doing those kinds of things, and in exchange, you're going to give up your control as an investor. You're not going to run the property, you're not going to manage the deal. The general partner, the person putting together the deal, is the one that's going to do that. You're trusting someone with your money, they're going to run the project and give you returns on your deal. So economics versus control is really what it comes down to when we talk about syndications and what you do in here, right? So what is a syndication, right? Let's say you want to go buy 123 Ocean Avenue, and it's a multifamily apartment complex, right? Purchase price on that thing is $10 million. Sure, you're going to go to someone like Joe, you're going to get leverage for it, but even Joe is going to require you to bring about 20 to 30% of that to the table, right? You're going to have to bring some cash to the table. Now, if you've got that kind of cash laying around and you can invest it yourself, you don't need to do a syndication. Frankly speaking, keep it yourself, right? But about 99% of the rest of us, we will need to raise that investment money from other people, right? So we're raising a syndication. And syndication is simply a pooling of investors to make enough equity, to make enough money to put in a kind of deal like that, right? So that's what a syndication is in a nutshell as a definition, right? It's about deals that are larger than one person, and it's about raising private money for a private investment deal. And that's a pretty big difference, and that's a pretty big reason to understand is because we're not talking about public equities. We're not talking about public markets or raising from the stock market and things like that. These are all private deals, right? A syndication is typically going to be about a 3 to 7 year hold, right? We're going to buy this multifamily apartment complex. We're going to rehab it. It's going to take us a couple of years to do that. Then we might refinance it, or then we might sell it, or whatever else might happen to it. So when you invest in a syndication, you should be prepared for a bit of a long-term nature of the investment, right? It's going to be about 3 years. It can be up to 5 years, maybe 7 years for the investment, right? We already talked about sort of a little bit briefly economics versus control, but what I really want to get into is what those deal terms look like, right? So if you're investing in a typical syndication, the types of things that you should be looking for is what we call a preferred return, your cash on cash, investments, and I'm sure these guys are going to get into a lot more of the actual economics, but just to give you some background on some of the legal definitions you should be looking for, are things that we want to talk about, right? When you invest in this deal, you're going to be, like we said, a silent investor, right? So you're just putting in your money and you're going to be getting back these returns. So what returns are we talking about, and what does that look like, right? The first thing is what we call the preferred return. Think of it like interest. It's interest on your money, right? So if I'm investing $100,000 into this deal, and you're telling me, for super easy math's sake, not saying this is a standard term, but you're giving me 10% as my preferred return. Think of that preferred return literally like interest. I am owed 10% on my $100,000, not of it, on it. So it's interest, right? But it's not actually interest, because remember that this is not a loan, this is an investment. You're investing your money. You could lose it all, you could maybe not get that. It's not a secured debt, it's an investment. But still, there's a preferred return, right? The preferred return is often referred to what we call as the hurdle, right? And what does that mean? It's a hurdle to what, right? Because in a syndication deal, the payout structure, this is what everyone's here for, right? Everyone's here about these things to make money. So the thing that makes money is what we call the distribution scheme, or the waterfall, right? The waterfall talks about what we're going to do with the profits that we generate from this syndication deal. Profits, so not including expenses, so paying back, Joe at the bank, paying for expenses of all the materials and the rehab costs or this and that. After all of that, let's say the project goes super successful. At the end of year 5 or whatever it is, how are we going to distribute that cash, right? And what governs the distribution of that profit is what we call the waterfall, or the distribution priority, right? And it's going to say something like this. This is a pretty typical waterfall for a syndication, right? First, everybody's going to get their money back. So if you invested $100,000 with me, you're getting your $100,000 back today. Then second, I'm going to give you that preferred return that I owe you for those 3 years or 5 years, assuming that I haven't been able to pay it out consistently year after year. But now I owe you that preferred return. So if it was a 5-year deal, I owe you 5 years worth of preferred returns, right? So I'm going to make sure we make good on that. That's why that preferred return is called the hurdle, because it's the hurdle to the split, which is the last thing that happens. So after I paid you your money back, after I paid you your preferred return, whatever is left, I'm going to split with you. I'm going to get to take 20% of that right off the top as the manager, as the operator, the general partner of the deal, and the remaining 80% of it is going to get split pro rata amongst all the investors. Now, sure, you guys are looking at this and going, okay, well, that's after all of these things. Is there really a lot of money left? And honestly, if the deal goes right, yes, there's a lot of money left. And that's a very, very lucrative position to be in as a general partner. That 20% split you get at the end of the deal, right off the top after that, can often be a lot of money, right? And so this is why people get into syndications. This is what syndications offer as an investment opportunity if you're the general partner putting together a syndication. And as a limited partner, as an investor, you're getting preferred returns along the way, and you're still getting some of the cherry on top of it, right? So, long story short, this is what the economics of a typical syndication usually look like. Results completely vary, obviously, but this is a general structure of what we're talking about, right? In addition to returns, though, the general partner gets to take certain fees, also as expenses, right? So if I'm managing this deal, if I'm putting together a syndication, and I'm going to be handling this thing from A to Z, I get a project management fee. And usually that's about 2%. So 2% of all the profits being generated at the property, or 2% of the total amount I raise, I'm going to get that annually as my paycheck, as the general partner who's putting together the deal. So you're getting cash flow all while this is happening, because you're responsible for the deal and you're making it happen, right? In addition to that, sometimes, not always, I'm also going to get asset acquisition or asset sale fees. So when I buy the asset, I get a fee of usually 1% to 2%. And when I go sell the asset, if I'm able to make more money on it, I'm going to get another 1% to 2% fee. So you can see that being a general partner, there is an opportunity to make a lot of money on a syndication deal, as well as being a limited partner, right? This is what a syndication actually looks like on paper, and structurally speaking, visually speaking, right? This is it. It's really as simple as this. The middle of this thing is what we call the fund, or the syndication, right? And it's usually going to be structured very simply as an LLC, which is what we call a limited liability company. It's a super flexible, super affordable type of legal structure that you can put together to do one of these deals, right? On the left-hand side is what we call the manager or the general partner. That's you if you're putting together the deal, right? Now we form another entity for you to do that because you don't want to personally be that general partner, but more on that, kind of later. And then on the bottom here, all your investors. So effectively what you're doing is you're taking this company, we're forming a new company, and you're going to sell pieces of that company to all of these investors. So they get a piece of equity in that entity in exchange for their investment, and that entity is what ultimately is going to own 123 Ocean Avenue, right? So visually speaking and from a structure standpoint, this is what a syndication looks like. And this is what somebody like myself or another attorney who handles these kinds of matters, this is what we do. We structure this whole thing for you from A to Z. We structure the terms of the deal. We structure all of those kinds of things that go into this. These guys on the table are the ones that bring you the deal and figure out what those economics are, and they're the ones that are hustling to make the deal work and putting the deal together, right? I'm going to skip through some of these things here. Securities compliance. Really quickly, 2 seconds before we open this up to Q&A to everybody else. Don't mess this up. In the United States, when you sell equity securities, because like we talked about here, right, what you're actually selling to investors is not a piece of 123 Main Street. You're selling them a piece of Fund LLC. You're selling them an equity piece of this company. That means you're selling them what we call equity, or you're selling them what we call a security. Just like stock in Apple or stock in Google or whatever it is, you're selling them shares of that LLC. So anytime you're doing that in the United States, doesn't matter if it's a private company or a public company, you're going to be subject to Securities Compliance from the SEC. They vary differently from public securities to private securities, but there is still regulation even on public securities. So the long and the short of it, I'm not really going to get into all the different types of things that happen here, but the long and the short of it is, before you do something like this, please talk to an attorney who is experienced in securities compliance, because you have to have a securities attorney make sure that you're filing the right documents and you are compliant with SEC regulations when you go to raise these investment dollars for deals like syndications. That's pretty much it in a nutshell. I know I went through this really quickly. I normally spend a lot more time on the slides, but today you have like a wealth of knowledge on the stage, and I want to make sure that everybody gets to hear from these guys as well. So I went through this rather quickly. We can certainly answer more questions about this or go into this in detail, but that's pretty much it.
So,
Yeah.
Before we open it up, just to clear up a lot of stuff, do you want to talk about the Reg A, CF, and D funds, just to give them a quick overview?
We can do that, yeah. I mean, I don't want to muddy too many of the waters here on something like this, because this can get very complicated. But basically, when we talk about securities compliance, there's really three different areas, three different regulations that would apply, right? That you have to kind of determine what your goals are. Like, are you going to need to raise money from the public at large, and you're going to need to generally solicit or advertise? Are you going to need to take investors that are not accredited investors? And by the way, just generally speaking, an accredited investor is someone who has a net worth of over $1 million, excluding their primary residence, or they have made $200,000 in annual income for the last 2 years in a row, or $300,000 if they're married filing jointly. There is a host of other things that can allow you to qualify as accredited, but generally speaking, that's what it is. So certain regulations will allow you to take non-accredited investors, right? So it does depend on your goals, but generally speaking, what Ryan's talking about is there are three main regulations that could apply to you based on those goals. The first is Regulation D, the second is Regulation CF, and the third is Regulation A, or sometimes A+, right? And basically, about 90% of your real estate funds are all going to be Regulation D, because it's the easiest one. It's the one that requires the least amount of compliance mechanisms. It's the one that is the quickest to set up, requires the least amount of paperwork at the SEC, and frankly speaking, is the most cost affordable. The second one is Regulation CF, or what is commonly known as Regulation Crowdfunding. This is probably the one most of you guys have all heard of here. So when you go online to, like, what are those like crowdfunding sites for real estate?
Fundrise.
Yeah, Fundrise, all of those kinds of things, right? So those could be Regulation D as well. They could be doing a Regulation D raise, but for the most part, they're doing Regulation CF, right? Which is Regulation Crowdfunding. And so from there, you're going to be looking at raising up to $5 million from a whole host of people, including a lot of non-accredited investors, et cetera, et cetera. And then finally, the third one is what we call Regulation A, and it is the most expensive, the most costly, and it is oftentimes referred to as the mini IPO, because it's basically like taking a company public. It's not exactly, but it's sort of like that. It's very expensive, it requires a lot of work, but it allows you to raise significant sums of money from a whole lot of people and cast a very, very wide net. Each of those, again, like I said, are going to sort of depend on the goals that you have, the type of raise you're doing, and the type of deal you're doing. But again, it's another reason you really, really need to talk to an attorney before you start any of these things.
So when I pose some questions to the other individuals in the panel, and you could kind of jump back in. Glenn and Antonio, being commercial real estate brokers, when somebody comes to you and says, hey, listen, I have a syndication, where does that conversation go in regards to identifying an asset, to leveraging that syndication along with financing as well, knowing that financing is going to be in place? They have the 20 or 30% for that matter. In your experiences in the past couple of years, have you seen more or less of syndication, and the discussion's more, I'm going to say, a little easier to discuss, or does some people get a little, again, I'm not going to really tell you just yet until you identify the asset. Just trying to get a feel of what's going on on your side from the real estate broker perspective.
There's definitely more people, like substantially more people, doing syndications over the last several years than what we've seen previously. It's just becoming a more and more popular thing, and like we're sort of discussing here, it's a way for a lot of people to get into bigger deals and leverage other investors, and so it's something we're commonly seeing. And I'd probably say a couple of years ago, no one wants to tell you they're syndicating and don't have the equity. Everybody sort of pretends like they have the equity there already and the buying power, but more and more we've been having conversations up front. I think that's important. From the broker's perspective, it's super important that your broker understands, if you're aligned with your broker, of course, your broker understands where you're at from an equity position. Is the money soft committed? Have you had those conversations? What's your experience like? What's your operating history like? Obviously all staying within the guidelines of what you can and cannot do from a securities law perspective. But for us as a broker, if you come to us, if a sponsor were to come to us and say, hey, I'm looking for a $10 million transaction, like to help you find an apartment building, 100 plus units, and so geography. The first question, one of the first questions we ask is, well, what's your experience and where's your equity? And oftentimes when you put in an offer on a transaction, if you've gotten that far, most brokers want to know, as part of your letter of intent, part of your LOI, where's your equity coming from? Is it a single investor? Is it your own equity? Or are you doing a syndication? And if you're doing a syndication, our next question is, well, how far along are you? Do you have a securities attorney? Have you done this before? It's a very common thing for us to see syndications happening and a lot of first-time syndications happening. So don't feel like you're never going to be able to get a transaction, or don't feel like you need to be sort of scared of the process. It's just being open and transparent and working with a team that can help you through the process. I think is super important, especially in today's super competitive buying market. Hopefully that answers.
Yeah, that helps out quite a bit. Ryan, your thoughts when somebody comes to you in your circle? You know, you put out a lot of educational workshops, and you know, how is the conversation started, or at least strategized with your investors? Is it okay? Where do you want me to send the money? Do you ask certain questions? There's certain thresholds that an individual needs to go through before you push that money out to whatever syndication that they're going to invest into.
So I'm going to back up a little bit on that. So there's two ways you can use these accounts, right? Obviously, and I encourage everybody to use their own accounts and grow their own wealth. For anybody in here that doesn't have a Roth IRA, I would say get one. And they're going to be, it looks like they're going to be changing some rules up, especially if you make over 400,000. You might not be able to get one come 2022. Nothing's been finalized, but I read an article the other day on that. But even if you already make too much money, anybody can have a Roth, at least right now. And we have clients that put money in and then into their traditional IRA, because it doesn't matter how much money you make, and then they just convert it to their Roth each year. And you can convert any amount you want. If you have $10 million in your IRA or 401k and want to convert it to a Roth IRA, you can do that. So it doesn't matter how much money you make for conversions, but do look at that, get an account set up. I think it's the best thing. It's tax-free, it grows tax-free for the rest of your life. But either way, use your own IRA. You can't lend to yourself, and I won't get into a bunch of prohibited transactions, but you can look at it on our website. There's a chart, and there's 10 bullet points, and it's pretty simple. But use your account to grow your own wealth. And I don't have a chart here, but I'm going to tell you this real quick before I make my next point. Everybody envision, and some of you are clients in here, you've probably seen this in presentations, but envision a bar graph, $50,000 in your Roth IRA. I'm just going to use a traditional. It could be any tax deferred account, but let's just say traditional IRA. And you personally, I did it with a 10% return and a 30% tax bracket. So $50,000 in your Roth traditional, and I forgot your name. Perlet personally, okay? So 10% return, I'm just going to go right to the end of the chart at 40 years. Your Roth IRA has 2.2 million, and I'm rounding off, by the way. Your traditional IRA has 2.2 million, but let's just say taxes stay the same like I did it when I did the graph. So you got to take 30% out. So now you have 1.5. And then you personally end up with 748,000. You didn't do any more work. You had the same amount, 50,000 in each account, 2.2, 1.5, 748,000. So that's where you're really going to grow your wealth in these tax deferred and tax free accounts. But when I did that with 30%, I don't know what it's going to be in 5 years, 10 years from now. I mean, taxes are already set to go up now. So it's really something that everybody should look at and make part of their plan, because I don't see a lot of, I don't think the government's going to help us that much. Maybe they will, maybe they won't. But they're already saying if you're making money, and everybody in this, who in here would be doing more deals if they had more money? Right? I mean, there's trillions of dollars in retirement accounts. So that's going to lead me into where I'm going now. How much of that do you need to get your deals? So right, do yours on your side with whatever you're going to do. Now, if you're going to raise money or you're going to do a syndicate, and you don't, by the way, I know we're on syndications, so you don't have to do a syndication, you could say, hey, I know 1 or 2 or 3 people that'll lend me money on this property, right? Then it's a note. You can do a note. Hey, you have a friend that's a doctor and he says, well, I have $5 million in my account. What do you need? You need $400,000 for this property? Sure, pay me 10%. They love to know this stuff. 3% roughly of the country knows about self-directed IRAs. That's how many people don't. And don't be offended when somebody, the common answer I get is, yeah, I've heard about it. Nobody likes to sound dumb, right? So, yeah, I've heard about it, but I don't know much about it. Well, they don't need to be an expert on it. All the rules are the same at the brokerage houses as they are with us. Schwab, Fidelity, Merrill Lynch, distributions, contributions, all the same. All we are is an administrator to keep it legal for the IRS, right? Instead of buying a stock, you lend money to ABC LLC, right? Or whatever syndication, right? So it's a very simple process, but most people don't know about it. They don't know that they can do it because they're following the green line of Fidelity, and that's what they're used to. So there's a ton of money out there in these accounts. I mean, trillions of dollars. How much do you guys need of that, right? So when I work with syndicators, depending on it, roughly though, 50% of their funds are coming from self-directed accounts. So that's a lot of money, and people raise money more quickly from what I see because, I read an article, and this was years ago, they say people have 7 times the amount in their retirement accounts than they do in discretionary funds. So I'm just making up numbers here. So while somebody says, well, I only have $50,000 to give you out of my pocket, and then you say, oh, well, did you know you could use your retirement account? They're going to say no, most likely. Oh, well, I can give you $250,000 out of my IRA or 401k or whatever it is. So it just opens up more funding, or you get double the funding. Here's $50,000 from my pocket, and here's $250,000 from my IRA. So you're able to get more funds and more quickly, usually by letting people know that they can, use these accounts, and I think you can vouch for that as well.
That's going to lead to some of that. Can we talk about, I know you briefly were talking to Ryan and Antonio, some pros and cons that you have witnessed. You don't have to give any names, no projects, but where have you seen some things go sideways and some that have done very well, maybe for syndication now?
Yeah. So a couple of things on a syndication, right? Like we talked about, right? A syndication at its core, legally speaking, is an entity. It's a company that you form. People own shares in that company, and they're going to get paid based on those shares for their investment dollars, right? Obviously, it goes without saying, one of the major things that people do wrong in a syndication is they don't structure this properly. So what happens when it's time for distributions of profits or when it's time for exit strategies, the documents don't actually tell us what we need to do and how it's going to happen. So it's going to lead to a bunch of conflict, right? So before you start a syndication, and presumably at the same time you're doing your underwriting on a deal, you want to start looking at what those economics look like to be able to pay your investors back. And you want to sit with the attorney and you want to start going through a first draft of what those waterfall distributions need to look like, what the preferred return needs to look like, what are my fees going to be, right? All of that from a legal perspective, right, is where people will really screw that up and not probably have that accounted for, or think they can achieve something, or think that they know what a preferred return is and actually are saying something different, right? So you really want to get to the crux of what all of those economics want to be, and you want to have those really nailed down, right? That's from a legal perspective, but from an operational standpoint, I can tell you horror stories all day, right? People will certainly mess up syndications. At the end of the day, this is an investment deal, right? And in any investment deal, one of the documents that I'm going to draft for you is what we call the PPM, or the private placement memorandum. It's a disclosure document. And that disclosure document is going to basically make your deal sound like the worst deal in the world, right? It's going to tell you that, hey, you could lose all of your money because an asteroid could hit the planet. It's going to tell you that you could lose all of your money because we could have a severe drought, or there could be environmental hazards present on the property, or there could be this, that, and the other. And it's important that we disclose all of those things, maybe not so much the asteroid, but everything else, right? Because at the end of the deal, sometimes these things just are outside of your control. You could be the best operator, the best multifamily syndicator, and sometimes things just don't go well. But if you're properly protected, if your attorney has drafted your PPMs, at least you can sleep well knowing that your investors are not going to have a good claim against you. Look, we disclosed these risks. We made it very clear in our documents when you invested with us that this is an investment, that this is a risk, right? I can't tell you the number of times people think you can just set up a syndication, not do a proper PPM or a whole PPM or do the securities compliance, and then sure, they might get away with it because truth be told, the SEC, anything that's call it less than like $50 million is probably really small potatoes. But I can't tell you how many times people have thought exactly that. And it's not just the SEC you're worried about. You don't do this deal properly, you don't issue a proper PPM, you don't get all of those disclosures properly, and you don't get your investors to sign those documents. When the deal goes bad, and there's always a risk that it does, it's not just the SEC coming after you. Your investors are going to sue you for fraud, and on top of that, if you didn't do a proper PPM or file the securities compliance, they're going to sue you for securities fraud. Now the SEC is coming, right? So again, I'm talking about all these things from a legal perspective because I'm the lawyer in the room, right? These guys probably have a ton of other horror stories from an operational standpoint about why the deal went wrong or what the operator did and things like that. From a legal perspective, though, it's very important to know that you really need to do all of these documents. Doesn't matter if you're raising $500,000 or if you're raising $5 million. It's the same thing. All the disclosures need to be present. All the compliance measures need to be followed.
I agree. I'm just going to chime in real quick if you don't mind, Joe.
Yeah.
I agree that that is very important, and I grew up, my dad always said, it's better to do it right at the beginning than it is to fix it. Usually
Yeah.
that's more expensive to do.
Okay.
So you do want to get your accountants and attorneys involved. I'm not I can't give any tax or legal advice, put my disclaimer up there.
I make
But-
more in legal fees if I have to come back and fix your deal. Just letting you know.
Good for you though.
Yeah.
But generally speaking, for everybody there, it is very important to do this stuff right from the beginning. I mean, people go to jail for this, and as you were saying, depending on how long it is, and again, I'm making up numbers, the first 60 pages of the PPM are going to say how bad this deal is, right? And you're going to lose all your money here. And the last 10 say, well, if everything goes as planned, here's what you're going to get, right?
Yeah.
So there's two sides to that. You want to, have, your professionals involved in doing this and doing it correctly, because if something does happen,
Yeah. And it's not that we're trying to scare you guys from doing a syndication. There's a lot of good potential in doing syndications, especially in real estate, or raising funds for a good real estate project that you know looks good, that you've done your due diligence on, you've done the homework on, the deal lines up, the numbers add up, it's a good deal, you're confident in it, and you're good at what you do, right? No, absolutely. There's a lot of opportunity in this space. There's a lot of opportunity in real estate. All we're trying to say is just make sure you do it right when you do it.